Bismillahirrahmanirrahim. Assalamu alaikum students. Today we will cover the following topics. First is the systematic and unsystematic risk. Second, major diversification. Third, diversification and the elimination of unsystematic risk. Fourth, the capital market line and the separation theorem. Fifth, a risk measure for the capital market line. And the last is the capital asset pricing model, expected return and risk. Systematic risk versus unsystematic risk. In the previous lecture, we have concluded that the M portfolio on the capital market line that touches the Fiat frontier consists of all risky assets, and that portfolio contains only systematic risk, and the unsystematic risk is completely diversified away, and that is why we call it a completely diversified portfolio. So the risk that exists in the market portfolio is the systematic risk. So what is the systematic risk? It is the variability in all risky assets caused by macroeconomic variables or macroeconomic settings or macroeconomic factors. So if there is a change in the macroeconomic factors or variables, these changes affect all the risky assets in the market portfolio. What are these macroeconomic changes? That might be a change in the growth of money supply, or there is a variability in the interest rates, or there is a variability in the industrial production index, etc. So these, if there is a change in these variables can affect the whole market, and it does not only affect the individual securities in that market. So that is why we call it a systematic risk, and this systematic risk cannot be diversifiable. Systematic risk can be measured by the standard deviation of returns of the market portfolio and can change over time. Unsystematic risk is a firm-specific risk and can be diversifiable. So a completely diversified portfolio, which is a market portfolio, M portfolio, that portfolio completely diversifies the unsystematic risk. It means that it completely eliminates the unsystematic risk, which is a firm-specific risk or an industry risk. So example of a unsystematic risk is a labor strike or poor earnings, etc. How to measure diversification? So all portfolios on the capital market line are perfectly positively correlated, which means that all portfolios on the capital market line are perfectly correlated with the completely diversified market portfolio. A completely diversified portfolio would have a correlation with the market portfolio of positive 1. So the portfolios on the CML line must be perfectly positively correlated, and these portfolios are perfectly correlated with the completely diversified market portfolio, and the correlation coefficient must be positive 1. So that is, if you are constructing a portfolio, that portfolio must have a positive 1 correlation with the market portfolio. So in that sense, we call that portfolio a completely diversified portfolio, because in a completely diversified portfolio, we eliminate all the unsystematic risk. The only risk that left is the systematic risk. So this is logical because complete diversification means the elimination of the all unsystematic or unique risk, and only systematic risk is left. Therefore, completely diversified portfolios would correlate perfectly with the market portfolio because it has only systematic risk. Uh, we know that a completely diversified portfolio cannot eliminate the systematic risk. So the only risk that exists in the completely diversified portfolio is the systematic risk. But through this diversification, we completely eliminate this unsystematic risk, which is a unique or firm specific risk. Diversification and elimination of unsystematic risk. So the main purpose of diversification is to reduce the standardization or risk of the total portfolio. This assumes that imperfect correlations exist among securities. So as you add securities, you expect the average covariance for the portfolio to decline. So here is the question: how many securities must you add to obtain a completely diversified portfolio? So one set of studies examined the average standard deviation for numerous portfolios of increasing number up to 20 stocks randomly selected of different sample sizes. The results indicated that about 90% of the maximum benefit of diversification was derived from portfolios of 12 to 18 stocks. A subsequent study compared the benefits of lower risk from diversification to the added transaction cost with more securities. It concluded that a well-diversified stock portfolio must include at least 30 stocks for a borrowing investor and 40 stocks for a lending investor. In this diagram, you can see that by adding number of stocks in the portfolio, we are able to reduce the unsystematic risk. You can see here that initially the unsystematic risk is reduced at an increasing rate and later on it is reduced at a decreasing rate. So by decreasing the unsystematic risk, we are decreasing the total risk of a portfolio. But on the other hand, the systematic risk is unchanged and constant. So by adding number of stocks in the portfolio, we cannot reduce the systematic risk. The only risk that we can reduce is the unsystematic risk, and this is the reason why we can reduce the total risk. So a diversification is helpful in reducing the unsystematic risk, and by reducing the unsystematic risk, we can reduce the total risk of a portfolio. But we cannot reduce the systematic risk, which is a non-diversifiable risk. Now we will discuss the capital market line and the separation theorem. As you know that the capital market line leads all investors to invest in the M portfolio. As you know that M portfolio consists of all the risky assets portfolio. It's an optimal portfolio. It's a complete diversified portfolio. So all investors want to invest in that portfolio because in that portfolio they can eliminate all the unsystematic risk. So the individual investors should differ in position on the CML depending on their risk preferences. We know that the individual investors have their own risk preferences, and if they are less risk averse, they can take a position below the M point, or if they want to take a higher risk, then they can take the position on above the M point on the capital market line. So how an investor gets to a point on the CML is based on its financing decision. Either he can lend or he can borrow money to invest in the M portfolio. Risk-averse investors will lend part of the portfolio at the risk-free rate and invest the remainder in the market portfolio. As you know that by buying the treasury securities or risk-free securities, and the remaining and the remaining portion he can invest in the market portfolio. So by in this way he can take a position on the capital market line below the M portfolio. Secondly, investors preferring more risk might borrow funds at the risk-free rate of return and invest everything in the market portfolio. It means that if investors want to earn higher return than the market portfolio, then they have to take a higher risk by borrowing money at the risk-free rate of return and then invest everything in the market portfolio. The decision of both investors to invest in portfolio M along the CML line is the investment decision. The decision to borrow or lend to obtain a point on the CML is a separate decision based on risk preferences, and it is known as the financing decision. The investor either borrow or lend money and to take a position on the capital market line. It is totally based on their risk preferences. So if the investor wants to take a less risk, he can lend, and if he wants to take a higher risk, he can borrow money and take a position on the capital market line. So the Tobin refers to this separation of the investment decision from the financing decision, the separation theorem. So this phenomena is known as the separation theorem. A risk measure for the capital market line. Covariance with a market portfolio is the systematic risk of an asset. As you know that M portfolio is a market portfolio which consists of all the risky assets. It's a complete diversified portfolio. So in the M portfolio, there is no unsystematic risk. The only risk that exists in the market portfolio is the systematic risk. So how to determine the systematic risk of an asset? So it is simply a covariance of an asset with the market portfolio. So in this way, we can determine the systematic risk of an asset. A Markowitz portfolio model considers the average covariance with all other assets in the portfolio. So if you remember the Markowitz portfolio model, अगर आपको याद हो Markowitz portfolio model, जिसमें हमने assets जो हम लिए और उसका portfolio बनाया, तो जब हम उसका risk consider कर रहे थे, तो हमने उसमें covariance determine किए थे एक asset का दूसरे asset के साथ. So the only relevant portfolio is the M portfolio. So instead of taking the average covariance of an asset to other assets in the portfolio, तो ये आसान चीज़ ये है कि M portfolio जो है उसमें क्योंकि सारे रिस्की एसेट्स हैं, तो हम बजाय इसके कि हम एक एसेट का दूसरे एसेट के साथ कोवेरियंस डिटरमिन करें, हम एक एसेट का M portfolio के साथ जो मार्केट पोर्टफोलियो है उसके साथ कोवेरियंस डिटरमिन करें, तो उससे हम सिस्टमैटिक रिस्क ऑफ एन एसेट डिटरमिन कर सकते हैं. So together this means the only important consideration is the assets covariance within market portfolio. इसका मतलब ये हुआ कि जो इम्पोर्टेंट थिंग है वो ये है कि हम एसेट्स का कोवेरियंस डिटरमिन करें मार्केट पोर्टफोलियो के साथ, क्योंकि जो मार्केट पोर्टफोलियो है वो कंसिस्ट करता है ऑल रिस्की एसेट्स. तो इंस्टेड ऑफ कैलकुलेटिंग द कोवेरियंस with an individual asset with the other assets, it is easy to calculate the covariance of an asset with the market portfolio. So in that way we can determine the systematic risk of an individual asset. Because all individual risky assets are part of the M portfolio, an asset's rate of return in relation to the return for the M portfolio may be described using the following linear model. So RIT is equal to alpha plus beta R Mi plus epsilon. So here RIT is the return for asset I during period T, and A or alpha is the constant term for asset I, and beta is the slope coefficient for asset I, and RMT is the return for the M portfolio during period T. M means the market portfolio. An error term, it is the random error term. So this is a linear model, and by using this model we can determine the return of an asset I. The capital asset pricing model, expected return and risk. So to this point we fully understand that an asset's covariance with the market portfolio is the relevant risk measure. So this can be used to determine an appropriate expected or required rate of return on a risky asset. So it leads us to the capital asset pricing model. The capital asset pricing model indicates what should be the expected or required rates of return on risky assets. So the capital asset pricing model helps us to determine the appropriate expected or required rates of return on risky assets. This further helps us to value an asset by providing an appropriate discount rate to use in dividend valuation models. If you remember the dividend valuation models, we use these models to determine the intrinsic value of an asset. So the capital asset pricing model is providing the required rate of return that can be used as a discount rate in the dividend valuation models to determine the intrinsic value, the fair value, or the economic value of an asset. You can compare an estimated rate of return to the required rate of return implied by capital asset pricing model and determine whether the asset is undervalued, overvalued, or properly valued. So by comparing the estimated rate of return, the return that is provided by the investor, that is estimated by the investor, to the required rate of return that is provided by the capital asset pricing model, we can determine the asset whether it is undervalued, overvalued, or properly valued. So I think it is enough for today. Further, we will discuss it in the interactive session. Thanks. Thank you very much.